Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is David Spreng, founder and CEO of Runway Growth Capital, and Ted Goldthorpe, co-founder and partner of BC Credit. We are here to discuss macroeconomic trends shaping the VC ecosystem and the role of venture debt. Gentlemen, it's great to have the both of you with us. Welcome to Trade Talks. And Ted, I want to kick it off with a higher level overview of how macroeconomic trends are shaping the venture cap ecosystem.
Yeah, I mean, obviously, what's happening macro-wise, particularly with some of these emerging technologies, has a big impact not only on our overall investment thesis, but also on our portfolio companies. So 25% of our business today is in technology, and we're doing a real hard look at around some of these recent trends and seeing how it impacts our existing portfolio companies.
Yeah, it's interesting because, David, I think the question that's happening now is, okay, we've made these investments, everyone's told their story, whether internally, externally, how these emerging technology products are being, emerging technology products are being deployed. What's that ROI? I think those questions need to be answered and figure out, okay, what's the next sector that's going to benefit from this?
Absolutely, and in our business, that is a critically important question. Many of the companies that we fund are not yet profitable, so they're borrowing money from us and comparing it, the cost of capital, comparing it to the ROI on what they can do with it. So if they can borrow $50 million from Runway and put a new product in the market, expand to a new market, or hit some other milestone that creates a massive inflection in their value, then it's a smart thing to do.
Which is interesting because the valuation reset that we saw in 21, 22, perhaps that was something that was necessary, where we start to think about, okay, what does the future look like versus putting money in, for growth at all costs? How has the environment shifted in terms of governance over the balance sheet, if you will?
So the big inflection point there was the WeWork IPO, and that's kind of, before that it was growth at all costs, and after that it's path to profitability. So I think a lot of CEOs have suffered from feeling a little whipsawed by their investors that were originally saying you got to grow as fast as you can because that's the metric upon which we're going to exit, to, oh my gosh, there's not enough money out there to keep funding this machine, this hungry machine, so now you got to get profitable. And that happened at the same time that there was a pullback in funding in venture land, so a lot of companies are hitting the wall. And we're seeing a lot of consolidation right now, and even some flat-out failures.
Yeah.
And rates, and also at the same time, rates going higher.
Yes.
So, the two most defensive sectors that have been historically for us have been healthcare and software. They tend to be more levered names, and they're the most impacted by some of the things that David's talking about.
Yeah. Well, I mean, think about it here too. We're looking at some sector-specific insights on your notes here, but consumer products, right? Now you bring in a whole other element in terms of what does it look like with tariffs and how costs are going to be passed around if to consumers. I mean, that's a really interesting debate. Is it going to be perceived that companies are taking advantage of higher tariffs, just like when we had higher inflation, and passing it down to the consumer? What are those metrics? How are if it costs $100 more on input for XYZ item, and you're passing down, let's call it $500 in cost? I'm curious to see how companies are going to think about how they're perceived.
Yeah, one thing we're looking at a lot at in our companies is price elasticity. So in 2022, when inflation started going up, companies were able to pass on price increases pretty dramatically, and not everybody's costs were going up. So going back to software, cost of goods sold doesn't go up, but they're able to charge more for their software on a same-store sales basis. And now there's much more pushback on price increase. So with inflation being subdued, it's harder to pass on price increases right in the face of potential tariffs. So it is going to be a very challenging time for certain businesses.
Yeah, and as we talk about the shift in bridging capital gap, because clearly there's more ways to access financing than traditional lending measures. Where are you seeing growth? What are those alternative funding sources for companies that are looking for growth, for capital to grow, rather than going through traditional routes?
Well, this is what I preach every day,
Yeah.
is that there are alternatives to traditional equity, and at a time where venture capitalists are being very stingy with their money, mainly because they're not getting reloaded from their institutional investors, that venture debt, or we refer to it as growth lending, is a fantastic alternative, and many companies are realizing that, and that's why our business is booming and has been for the last 5 years, and I think the environment is extremely conducive to that continuing to be the case.
Right, and that's the model over at BC Partners, right? How you're working with companies to figure out the sponsor financing model and moving away from more traditional lending models. Do you think that growth, that trajectory will continue? It seems as if there's a lot of demand, even on the investor side, for products wrapped around this. We were talking about it off camera before, like private credit. Is this getting too crowded? Is it sustainable? What are your thoughts as we move forward?
I think far from it. So, banks had a 94% market share in the middle markets, now to 4%. 86% of LBOs 2 years ago were financed privately. So the asset class is kind of here to stay, but it's institutionalizing. So we used to, the regional banks post Silicon Valley Bank, the Silicon Valley Bank failure, have really seized up lending-wise. So if you look at loan growth at regional banks, it's gone to zero. And so that's a huge opportunity to expand in new areas: venture debt, GP NAV lending, equipment finance, factoring, all these areas, lender-to-lender finance. These are all areas that historically were done in the banking system that continue to migrate into the alternative credit world.
Right, and so tell us, David, about the business combination between both of your companies. What does that mean? What was the genesis behind that?
Well, we're really excited to be a part of Ted's world now. Our original institutional sponsor was Oaktree Capital Management, and they had been an investor with us for 8 years. And as you know, that's a pretty long time in the world of private funds. And so they were interested in finding liquidity, and we said, we'll help you do that. And so we hired an investment bank that ran a very extensive process, and we came down to a couple really good bidders, and at the end, BC Partners Credit was the best fit in terms of structure, but most importantly in terms of culture. And the business that Ted runs is very synergistic with what we do in terms of his ability to help provide capital to us so that we can write bigger checks, because I think that's another major trend that we at Runway have really driven, and that we're writing bigger checks to later stage companies. And in some cases, it's what might have been an IPO in the old days. We can do a $200 million financing round, combination of debt and maybe equity, and let a company forget going public.
Without the volatility of the public markets. And yes, I work for an exchange, but we have to state the obvious here.
Yeah.
And you have to state the obvious here. And look, it's a trend, Ted. Companies are staying private for longer. One of those reasons being is to eliminate some of that volatility. And perhaps there are reasons for accessing the capital markets, whether public or private, are different than just going the IPO route.
Can't agree more. I mean, going public is one lever you can pull, and there's many other levers you can pull. I mean, there is pressure on velocity of capital, is what I would say, which is, private equity hold periods are all-time highs, venture hold periods are extending, and at some point, investors are demanding DPI, which is money returned to them from previous funds. And it's a cycle, so like to the extent that people aren't monetizing investments, it's hard for them to raise new money because people don't have money to commit to the new fund. So there's all kinds of things that are going on in our world right now, which are providing capital in alternate ways in order to kind of increase the velocity of capital in the system.
Okay, so let's talk about 2025 for a moment here, because everyone was waiting for the election to get out of the way, so we had a little bit more clarity and so forth. There is a lot of capital that needs to be deployed and redeployed. What are your expectations, in terms of what the investing environment is going to look like, whether it's exits or looking for other areas for fresh entries? I mean, you can only, especially in the private space, when you're thinking about your liquidity profile, you can only hold on to it for so long before investors are going to look for other ways to allocate capital.
Yeah, you can't be more right. So, the election happened. I think people, generally speaking, are very excited because, there's a whole bunch of pent-up deal flow that needs to happen. There's much more certainty now on things like antitrust, regulatory, government deficits, things like that. So I think on that side, it's all positive. I will say this tariff noise and uncertainty has caused maybe a bit of a slowdown. So if you talk to the investment banks, their pipeline for M&A is at all-time highs. Like there's a huge backlog of deal activity that has to happen. Prices have also come down. So the average LBO last year priced 2 turns lower than the previous year. So like pricing expectations are adjusting, but there is some uncertainty right now with some of these recent headlines around AI and around tariffs and other things that might delay some of this activity.
Yeah, but I mean that's going to be any environment, David, right? There's going to be some sort of wall of worry to climb.
Yeah, of course.
Right?
That's what we get paid to do.
Right, but I mean, look at the returns, just even over the past 2 to 3 years, right? So there's always going to be some wall of worry to climb, and the markets will figure it out. I'm just concerned about the sustainability as we hear so much more about private credit, and making sure that's the appropriate investment, or that there's enough liquidity to support the new ways of financing and so forth. But it sounds as if the industry is really specializing in different ways and more creative ways for capital, alternative forms of capital formation.
Well, so if you look forward 5 years and you say private credit blew up, what could have been the cause? It would have to be bad underwriting.
Right.
And we don't see that. The losses in private credit are very, very low, and shockingly low in the business that I'm in, where it's sub 2% for companies that aren't even profitable. So it says there's a lot of resilience in the world of private credit. So I know there's a lot of people that are saying, oh, private credit's grown so much, it's got to blow up.
Well, it's interesting. I've been learning through, as we start to cover this more, that the analysis into your investment selection and where you decide to deploy capital is more stringent than I would say traditional equity underwriting is, from what I've learned.
Well, so when Oaktree first came in and sat on our investment committee and looked at our memos, they're blown away. They're like, oh my God, you guys do as much work as we do.
Right, and they're well known for their work in the private
and they've got 150 billion under management. And so yes, we're extremely rigorous, and our whole mantra is about avoiding losses. So, and one might think, oh, well, one venture-backed company is the same as the next. That's just not true. There's a very wide range, and we target the largest and least risky, closest to profitability, best management teams, best margins, all that kind of stuff. And they may not be profitable, which is what keeps all the banks from coming into our industry, or it's what kept them out in the first place. But very often they can turn a few knobs and get profitable.
Right. Is there an advisory role that you play as well when you're working with your companies and so forth, your portfolio companies?
Yeah, I mean, there's a whole world of people who want the benefit of institutionalization.
Right.
And, but not everybody wants to sell control of their business. So historically, that's been the role of private equity. And in lesser cases, venture capital. We are, we're on a whole bunch of boards of companies. We provide a lot of strategic advice. And there's a lot of people who want capital, but they also want what you just talked about, which is institutionalization. Like they want advice around pricing strategies. They want price around macro trends, the impact of AI on businesses. If you're a middle market company, they don't have the kind of resources to spend money like we can, and we can bring that to bear for the portfolio companies. So it's a big, we are becoming a lot more like private equity as the industry evolves.
It has to be interesting working with the founder, CEO, right? You could be a startup company or, past your angel A round and so forth, where you can bring in a new management team, if you will, but the founder and CEO, it's their baby. It's got to be interesting working, with that.
There's a very, very big difference between working with a founder with an executive.
Right.
So we have parts of our business that we work with executives, or hired guns, so to speak. and those who founded their businesses in very, very different interactions and very different needs.
Yeah, would you say the same?
Well, 100%. I was going to emphasize that. So people come to us because our capital is cheaper than equity, economically, because there's no dilution, but they also come to us because of governance reasons. That, and often that is more important than the economics. The founder, this is their life's mission, and losing control of the company is more painful than paying a little bit extra in interest. So yes, 100% agree with Ted. And I was also going to say, one of the things that attracted us to Ted and his team was they have this notion of value-added lending. And very few lenders have that approach, and if they did, they couldn't execute on it. You know, that's part of our business and part of Ted's, and I think it's one of the reasons that we are attracted to each other.
And by value-added lending, you're talking about that advisory role, bringing the diversity of experience.
Correct.
Which I think is important. I mean, we hear, you know, different terms around diversity, but we don't mention experience very much. And, you know, because I think about it myself, like, you know, I created the show, we've been around for 7 years. I'm fortunate to have a lot of editorial latitude. I think to myself sometimes, what if we did have the luxury of resources and could bring more people in?
Right.
But then I'm like, oh, maybe I'll do a little bit of extra work so I can maintain, you know, the editorial direction that we're taking. So it's a great point that you make where, you know what, maybe I'll pay up a little bit more to retain control, but then also get the best resources available versus just, you know, getting money for the sake of.
Well, you founding this, building it for 7 years, you'd be a great advisor to the next Jill coming along. And that my background was in venture capital. I did it for many, many, many years and sat on more than 50 boards. And so I've seen a lot, and I can be very helpful. And I know Ted's is the same way. And you know, a lot of times what they're looking for are connections to customers, to potential employees, to funding sources, and that's certainly an area that we can help.
And that's a great point that David makes, Ted. I think, you know, in addition to diversity of experience, the power of networking and making those introductions, I think, is worth every penny, if you will.
Yeah, I mean, it's lonely at the top. Like, you know, CEOs really are grappling with issues that their peers are also grappling with.
Right.
And so when we can bring them all together, they not only do business together, but it provides almost like a, you know, a YPO forum for these people. You know, it's an advisory group. Like, you're right in the middle of it. Like, you know, people talk about AI. You know, one thing that is constantly being discussed with us is the fragmentation of media and the changes in media. So, you know, music's gone from analog to digital a long time ago and it's been successful, and media is just starting. So companies make all their money off traditional television, yet the world's going in a different direction. So how do you monetize that and look at eyeballs versus P&L? It's like, and that we're right in the middle of all that stuff.
Yeah, I mean, you're balancing.
A lot of it's technology related.
Right, well, we were talking about this earlier off camera, where it's so capital intensive for traditional forms of broadcast, if you will. Obviously, less when you're managing a podcast, which is probably getting, you know, 10, 15 times more viewership. And then again, you know, your format, there might be a sweet spot of 20 minutes, let's call it, but if you want to go an hour, 2, 3 hours, it's not like, you know, you have someone in your ear, like commercial breakers, and the way consumers are consuming news on demand or you know, podcasts were really the medium for the election this year.
Yep.
It goes back to what you're saying right at the start to David, which is ROI. Like, how do you measure ROI? How do you generate ROI? You know.
All right, well, appreciate both of your insights. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.